Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. Today's session, 2021 Market Outlook, the economy, equity markets, interest rates, commodities, precious metals, and currencies. A lot to cover in 1 hour. It features a very special guest I'm a huge fan of, David Hunter, Chief Macro Strategist, Contrarian Macro Advisors. David, welcome to the show.
Oh, thanks, Angelo. Thanks for having me.
It's my pleasure. Let's get right to it. MMT advocates contend governments that have their own national currencies do not have budgetary constraints. The belief is they'll never run out of money. Therefore, a government doesn't need to worry about the consequences of accumulating large debt. But David, we know that's really not true. What are the consequences of what we're seeing happening now, which is central banks printing, and printing some more?
Yeah, I think MMT is kind of a myth out there. It is something that will be stopped in its tracks when we see inflation as a result of all the money printing. So this idea that the Fed can keep interest rates low and keep spending, and the government can spend as much money as they want because it'll always be monetized. You sell more treasuries and the Fed buys them, puts them away. That works in very low inflation / deflationary environments. But I think we are off the charts in terms of the kind of money that's been printed this time. And when that translates a couple of years down the road to inflation and ultimately hyperinflation, you're going to see very quickly that it was a very flawed argument that we could do MMT. I don't even really consider what we're doing now MMT. This is kind of what we've seen during every recession as the Fed intervenes and tries to, provides a lot of liquidity, and ultimately that liquidity leads to a return to demand and a recovery. We just happen to be in a much more we're farther along in what I call a super cycle, so we happen to be in a more volatile, deeper downturn type period where it's going to require a lot more both fiscal and monetary expansion. So I don't really consider this MMT, although it looks like it. I mean, it looks like, and a lot of people want to believe this is just going to be extended ad infinitum, but it's going to come very much in conflict with inflation a couple of years out.
What would be signs that the Fed is losing control, assuming that they haven't already lost it?
Yeah, well, it'll be the fact that interest rates are moving up fairly rapidly and that inflation is starting to break out. Now, we have had a breakout from a long-term downtrend in inflation recently. And I do have a forecast out there that we are going to see into the second quarter. We're going to see a continuation of this inflation, what I call inflation surge. It's from low levels, but commodity prices, et cetera, are starting to really pick up speed. I think that's going to cause some short-term problems for the Fed. This is by no means the beginning of what I forecast will be a long-term inflation cycle. That will be a couple of years out, but for the time being, I think we are going to have a little bit of nervousness about this near-term inflation. And I think you'll see that manifest in higher interest rates as well.
It was coming up a little later in the interview, but since you brought it up multiple times and it's a sensitive point to, I think, investors, let's get right into it. I completely agree with you on inflation. My thought of it, let me know if I'm right, and please correct me where I'm wrong, which is frequently, is I think the whole thing about the CPI is government manipulated. The reality is inflation is specific to people. Now, let's take my audience, family offices, single family offices, the super rich. Okay, but let's just say they're living in New York, they're buying second homes in the Hamptons and Malibu, they're buying art, they're buying assets that are appreciating. I mean, I can make the argument 10 or 15% a year. To them, inflation is not some 1 or 2%. It's a complete myth.
Yeah, so I get this a lot on Twitter, et cetera, is people, when I start talking, because I have a forecast of a deflationary bust coming up, and people will say, there's no deflation. Look at my healthcare costs. Look at my grocery
Education,
bill.
right.
And, so it's a confusing thing because the basket that the government uses is somewhat contrived. But more than anything else, it's a basket where they can compare one period to another. So you want it to be fairly consistent basket of things that they're comparing. So that doesn't mean all things are going down in price. By the way, we aren't at deflation. Yeah, we've been in a disinflationary environment since the early 80s, since 83. It's been trending down from very high levels then to where we obviously got down close to zero. We're going to get a pickup this year in the first half, and then I think we're going to have what I call a second stage of the bust that really started back in last March because of the pandemic. I think we will see the second shoe drop on that bust. It obviously didn't go straight because we had big intervention on the part of the Fed and the Treasury and the government. So deflation is something that I think is ahead of us. It's going to be a fast, sharp deflationary bust, and I define the bust as something bigger than a recession. Can be the magnitude of a depression, maybe, but happens with the speed of a recession. So it'll probably be contained within a year. But we haven't had anything like that in the post-World War II era. So this is going to be pretty dramatic. Once you get that, you're going to see tremendous response from the central banks around the world because it's going to be global, and you will trigger with a lag of 18 months or 2 years a very big inflationary cycle. So the inflation I'm talking about for this year is really not part of that. It's kind of the precursor to I think it's going to lead the Fed to ultimately tighten here and bring on the second stage of the bust. So I'm jumping around a little bit here because it's a little bit confusing where we are in that, in that whole inflation story. But I do think we are going to see near-term inflation, real inflation, not just, some people get it and some don't. I think it will be, driven by commodities more than anything, but it will be enough that'll boost inflation expectations. And that's what captures the Fed's attention.
It's a joke to look forward 7 or 10 years. And I don't know if this is positive. I suppose it is, but it could have some negative consequences. So from deflation, inflation, hyperinflation, but we also know that technology and advancements that have occurred since the 80s are one of the reasons, arguably, for quote unquote deflation. If I look forward, not the next 2 or 3 years, and maybe it's closer to 10 or 15 years. So already we're crystal ball, it's impossible. But I could probably make the argument of solar energy and effectiveness and incredibly low cost energy, the Teslas of the world and climate change in cars, in food being produced and engineered and 3D printed, and even houses, that might lead to massive deflation, but it's almost comical to look that far in the future and think what could happen then. A bigger picture is, as AI and tech arguably takes jobs away, lessening expenses in the 3 or 4 things I noted, energy, housing, and food, would need to be, to some degree, essential. Otherwise, you'll have mass riots of people that just, you can't afford shelter and food, which is a basic necessity.
Yeah, well, I'm a macro strategist, and I believe by and large inflation is driven by monetary, the monetary expansion, because of what I consider to be a bigger downturn than anything we've seen in post-World War II era, and because of the massive leverage that's on the system, both here and abroad, you're going to have something that, and then you add in the pandemic, you're going to have something that if you thought 2008-9 was pretty dramatic, I think this is going to exceed that by a bit. And that leads to there's only one response that can be timely when you've got a free falling financial system around the globe, and that is money. You will see money come in at rates that we haven't even seen yet. So, we're up to 7.4 trillion in the Fed's balance sheet now. My forecast is that with this bust, the response that will be required, we could see something in excess of 20 trillion on the balance sheet within 12 to 18 months. So that's a huge, huge number. And we'll see proportionally similar responses from all the central banks around the world, because they'll be dealing with a free falling financial system that they have to try to stop. So it's that massive money that leads me to the belief that we will ultimately have, in the 2023 to 2029 period, a hyperinflationary environment um, that basically, and this is a pretty wild statement, but will retrace the last 40 years of disinflation slash deflation at the end here. So you could go back to 15, 20% inflation rates by the end of the decade, go back to 15% long bond by the end of the decade. Those are numbers that I think are beyond anybody's comprehension.
For sure. Which is going to bring up a question or questions coming up in probably 15 or 20 minutes, which is the ultimate for my audience, investors and family offices. But we're laying the foundation now. And that basically is going to be about how to invest. But we're not there yet. Let me go back a little bit to the MMT, since I think it's still important, central banks and all of that. Does MMT overestimate the revenue that can be earned for money creation? Or kind of really what I mean, is it like a drug where the government to its people needs more and more just to keep it effective? And that's going to add to our deficit, which you already said, but I want to hear it again.
Yeah, I mean, really, the truth is we've been expanding our government tremendously for the last several decades. Our standard of living would have dropped long ago if we didn't have the ability to continue to expand the government the way we have. It was not thought of as MMT, and it really came through several cycles and responses to cycles, et cetera. But ultimately, the reality is we're living on borrowed time and borrowed money. The standard of living has been held up through all this government borrowing, and the dirty little secret is that we're reaching the end of the limits to that, where when you start seeing that leading to inflation, and inflation begetting more inflation, that all comes to an end. So they, it captures people's attention, particularly those the politicians who want to spend money, to think that you can have your cake and eat it too. But the truth is, there's just this huge flaw in it that once inflation starts picking up, we won't have the ability to fund the debt. So if you can't service a debt, you can't keep spending. And the idea, the response you get from people who want to believe this works is they'll say, "Oh, the Fed will just cap rates." I lived through the 70s. G. William Miller wasn't called capping rates then, but he thought he was containing inflation by raising interest rates gradually. And the problem was he was pouring more money into the system, or else rates would have gone up even faster. That's what led to Paul Volcker coming in and having to really hike rates. He said, "We're going to let rates go wherever the market takes them, and we'll control the money." So that will happen again. Is they'll try MMT or some sort of thing like that, but ultimately the market's going to take rates higher and inflation higher, and they'll have to respond by tightening.
I mean, we're talking negatively, I guess you could say, and I think with pretty good reason, about the dollar and here in the US. But it's not like the other countries around the world. They're all going through challenges. They're all going through COVID. And I'm sure some don't have what we have here in the US, which is we're not incredibly old for an industrialized country. We have great natural resources, amazing farms, a great defense. So, yeah, I want to rattle the cage and make sure people are aware that there's lots that could go wrong, but it's not, the grass is not always greener on the other side.
Yeah, I think in the global bust that I say will hit us second half of this year, I think the dollar actually becomes, as it usually is in crisis, a place of refuge. You will see investors across the globe run to the dollar again, because we still are, the best neighborhood in a bad situation. So, I think you'll see. I've got a dollar forecast of 85 on the DXY index. I think in the bust, you could see it go from 85 all the way back up to 120, maybe higher. And that will be because the euro is going to be in trouble. You know, a lot of the currencies, Canada's going to be struggling. You know, there's going to be a lot of places where people are going to say, hey, you know, we're running to the US because we know their system, we know they'll hold. And down the road, the dollar's a problem again. But at least for the next couple of years, I don't think that's an issue.
What are questions that people should be asking relative to MMT, modern monetary policy in general, that you don't think they are?
Well, I don't know if I'd put it that way. Like I said, I think there's a lot of people that are rather naive about what the Fed can and can't do. The markets are really in control of interest rates. Now, when, you know, we've been spoiled because we're down at the end of, we're nearing the end of a long-term disinflation trend that took us down close to zero on both inflation and interest rates. So it makes it look like the Fed can control that. But once it starts going the other way, it's the market that dictates that, and they don't have the ability to do that. And I think there's this idea the Fed's all powerful and they can keep the stock market going up. They can keep interest rates low. That works in a benign environment, but once it gets, you know, again, inflation starts breaking out, the Fed's kind of the follower, not the leader.
I mean, you brought it up earlier. It's going to be more of a comment that I'll try to weave into a question. And I'm trying to put myself in the shoes of politicians. And I hate to say this, but I kind of understand they're in a tough spot. Everyone's vote, rich or poor, is a vote. So it matters. There's more have nots than there are haves. And a politician usually wants to be reelected. So even those that may skew to being somewhat more conservative are probably going to be in favor of stimulus checks of this or that. That does bring up the bigger picture question, and this will get dicey during mainly what you would define as hyperinflation, since there's way more have-nots than haves, and in theory, they'll control the political landscape. Might we have politicians come in that would make Joe Biden look ultra-conservative? That, you know, we may start to change the landscape of taxation, of, to some degree, socialism, and I'm sure from members of my organization, this is interesting in a very scary way. They would like for that not to happen, but what could they do as wealthy individuals to help educate and train philanthropy? How could they help what inevitably could be a challenging next couple of years?
Yeah, I'm not sure. You know, we've come so far along in terms of dumbing down the public's understanding of economics. And that's why we're in a position we're in today, where people elect people who are telling you they're going to raise your taxes. They're telling you they're going to distribute income. And there's, you know, as a student of economics for 50 years, I can tell you there's never been a time when redistributive economics works. Every time you say we're going to take and raise taxes on the wealthy and give it to the poor, every single time, guess who loses them in that equation? It's the poor, you know, because what it does is it hurts the economy and the people at the bottom suffer the most. So this idea that we can continue to go down a road, I mean, you know, look at the cities. They're probably the most guilty of trying to do that, and they're suffering because people are running away from them because they don't want to pay the kind of onerous taxes that are you know, in places like New York and Chicago. So what I think is really the problem is that we're decades and decades long in terms of ignoring economics as an important part of our education system. And I don't see that changing anytime soon. We can hope for it, but you know, it's a long-term solution that I don't think we're so far along in this now that I don't think even a few years of turning back to that is going to fix anything. So I do think we are looking at an environment where as we go forward through this decade, definitely higher taxes are coming. It's going to make it harder to see an economy that's productive. and I think we're going to suffer.
Uh, hmm. Some follow up there, but we'll maybe save that a little bit towards the end. Is gold inflationary protection against, or actually greater protection against deflation?
Yeah, I think it's much more of an inflation hedge. But I think either way, whatever, my forecast for gold is we're going to see $10,000 plus this decade.
Wow.
So
now like double the market cap.
yeah, and I think 10,000 is a low threshold. So, and by the way, silver I think can get well above 300. So we're looking at some big moves, I think, and that is going to be driven by that inflation slash hyperinflationary cycle that will build through the decade. So it won't be hyperinflation until we get towards the end of it. But you're going to see big moves, I think, in all commodities, but led by the precious metals.
Okay, kind of a long one. If the definition of inflation is too much money chasing too few goods, doesn't that make inflation very specific? Like I spoke about, but for instance, it all goes back to relative supply and demand. Example, oil demand is lower due to COVID-19, but if supply is cut off more than demand destroyed, then since oil is needed for certain things, the price will likely rise.
Absolutely. So the story there is that I agree that inflation is a monetary phenomenon. Therefore, printing money or expanding the money supply to the degree we have in the past year, 2, 3 years, 5 years, 10 years, and what I think is going to be an accelerated expansion going forward. That takes care of the demand side. And then if you do have policies, particularly in energy, for example, where you impact supply to the negative side, that's going to push prices through the roof. So again, my forecast for oil over the course of this decade is that before the end of this decade, we will see $300 plus oil.
Wow.
Yeah. So when you talked before about how you're going to have some real pushback because consumers, how are they going to live? How are they going to afford this? I don't have the answer to that other than hopefully the incomes come along and the inflation too, and that's usually a laggard. But it's I think that's what we're heading for. Yeah, we can talk all we want about alternative energy and EV, et cetera. It's not going to come that fast. You're
right. It's not ready yet. 15, 20 years, we hope.
Yeah. So fossil fuels are going to be an issue for the next decade for sure. And if we are, if you boost demand through this, reaction to what I call a second shoe of the bust, the global bust, that causes tremendous expansion of money with a lag, that will lead to a recovery cycle that is going to be, I think, very industrially focused. And the demand for energy in an industrial recovery, we haven't had one of those since the 70s, will push oil prices through the roof. So,
okay, let's get. I got people texting me saying, Angelo, we love the fact that you like to talk about this intellectual macro type stuff, and it's cool, but let's get to brass tacks. We're investors. So for a change, I'm going to listen to the audience. We're going to get into effectively investing right now. And if we have time, we'll bounce back and hopefully help to put that puzzle together. David, let me get right to it. Relative to a significant family with wealth and resources, let's get right into one of your wheelhouses, commodities. You mentioned oil, you mentioned gold, you mentioned silver. When families tell us that they're allocated 2 or 3% into commodities, which probably is about where most institutional investors are as well, I'm assuming you're going to laugh and say they better uptick that allocation.
Yeah, very honestly, I walk a very fine line. I'm a strategist. I am not allowed to provide any guidance or advice. So I can't answer those kind of questions. What I can tell you, which then you can extrapolate from, is I think the next cycle following this bust, again, I want to make it clear, my forecast very simply is melt up now, and I've been saying that since the lows in March, melt up to 4,500 plus on the S&P. 15,000 plus on the NASDAQ, followed by a global bust later this year, followed by a industrial-driven, inflation-driven recovery cycle that takes us from, say, second half of 2022 through the end of the decade. In that environment, leadership in markets changes cycle to cycle. So the leadership of this cycle will not be the leadership of the next cycle. In fact, the leadership of this cycle, which I define as the FANGs, technology, healthcare, consumer discretionary, even utilities, will not be the leaders of the next cycle. The next cycle will be, in my opinion, very much led by commodities. And we have not had a commodity cycle since the 1970s/early 80s. And that's what I think we're heading for. We have not had an industrial recovery since industrially driven recovery. Most of our cycles have been consumer driven. So the next cycle is going to be very different. And I think for the majority of people investing today, they weren't around in the 1970s and early 80s. I was managing institutional money back then. And I can tell you, it's a very different mindset. And it will be a mindset that means interest rates are going up and going up rather dramatically. So you can't throw half your money in bonds and just let it sit there and watch it grow. You can't count on index funds because index funds have outperformed or have been an easy place to put money for decades now because you had interest rates go from
losers.
You had the long bond go from 15% down to 1%. And how do you value stocks? It's the multiples are the inverse of interest rates. So as interest rates go down, your PE multiples have gone up on the market. We're going to have the reverse of that in the next cycle, whereas the interest rates are going up, PE multiples are contracting. So therefore, then it's the job of a portfolio manager or a person investing to find areas of the market where the earnings are outstripping inflation, where the earnings are outstripping the rises in interest rates. Because if you don't do that, you're going to watch your stocks go down. So there'll be parts of the market that are not going to perform well in the next cycle, but there'll be others that have not performed well in this cycle that are going to do extraordinarily well.
We are going to jump to that in a second. Maybe my last or commenting on the commodities, which again, no specific advice, but obviously for the next couple of years to 10 years, you're broadly very bullish on. So people are going to be familiar with gold, with silver, with oil. How about more niche plays in that, like uranium and rare earths?
Yeah, I think in the next cycle, and I want to stress, we're heading for a global bust after this melt up. And so as I use as the analogy, it's like standing on the south rim of the Grand Canyon and looking across the north rim and thinking you can walk straight across. There's a canyon in between. So same thing with commodities. They're hot right now, or they're doing rather well right now, but you have to be careful and not be linear in your outlook, because there's this canyon between here and the recovery cycle where commodities are going to do so well. So it's just not as easy as saying, okay, right here and now, allocate to commodities. Understand that there's, commodities are going to get hit hard if the economy gets hit hard. And I think that's what the story is for later this year. After we get through that bust, and I continue to say it's probably going to be a rather short one, maybe a year long. But once you get beyond that, commodities, whether it be uranium, whether it be ag commodities, everything. I think the entire commodity complex is going to do extremely well. So, and you can kind of take that one step further and say, if interest rates are going to be moving up dramatically, and I think you'll see double-digit mortgage rates as you get towards the middle to later part of the decade, that's going to impact real estate in a negative way fairly dramatically. The one area that could do very well in real estate will be the farm belt, because ag commodities are going to be going through the roof. Farmers are going to have a lot of money, and all the ancillary industries surrounding farm business. So I think you're going to see the coasts may not do very well in real estate, whereas the Farm Belt may actually do pretty well. So you got to think through some of these things. There actually are some things that move off of the commodity prices.
Interesting. And yes, of course, I was going to ask you about real estate and was going to ask you about public equities. So basically, of course, right now, FANGs are doing great, plus swap, Microsoft, Tesla doing amazing, etc. You believe that there may be a return to, let's broadly call it, it sounds like it's been outdated for 15 years, but value investing, maybe defense stocks and others. I think really broadly what you're saying, and I completely agree with, is yeah, from 2010 to 2020, a little bit of set it and forget it kind of worked, and being passive and being very beta. There's no way that that's going to be the approach to take moving forward. And I know some people that are massive believers in just set it and forget it and passive are going to have a heart attack, but you need to be tactical. If you're an active investor in a wealthy family office, like you said, if we're going to have deflation, you probably want to, have money in the dollar, arguably short-term bonds. But if it turns inflationary, that's a bad place to be. So you really need to be very tactical. I'm assuming you agree.
I absolutely agree, and I think it is. You are right. I think not only is it going to be a time for value investing, it's going to be a time for active management. We've had decades now where passive investing did better than most active managers. And you sat there and said, why are these guys making so much money? They can't even keep up with the indexes, That's going to switch very dramatically, I think, in this next cycle. And again, not all active managers are made the same. So you'll want to be with the active managers that understand we have a dramatic change in the landscape. And, we're not doing business as usual. We're not just buying growth stocks because all of a sudden you're going to be in an environment where, yes, value is going to be the story. Cyclicals are going to be the story. Inflation hedge stocks are going to be the story. And I take it one step further and say, I want to kind of stress this. I said it before. The two areas that I think are going to really change dramatically are passive investing is not going to be a place where you, like you say, you just kind of put it away and forget about it. And bonds. I can't stress enough. I do think in the bust you could get the 10-year down to zero. So I'm not saying we're quite to the bottom of rates yet,
right,
or the top in the bond market, but I think we'll hit the top in the bond market this year, maybe even first half of this year. And at that 0 yield 10-year or 0.5% 30-year, that's kind of my target for where we go. From there, it's all the other direction. And to the tune of, I fully expect a 15% 10-year, a 15% long bond by the end of the decade. If you translate that to what it does to a bond fund or a bond, it's a huge loser. And we have a lot more money. We have a lot more money invested in bonds across the world and across our country than we do in equities. And they are going to be dramatic losers in a portfolio. Now, what's something, again, people aren't used to doing, but we did back in the late 70s and early 80s, was you actually were better off not buying intermediate term bonds or long-term bonds. You were buying 90-day or 180-day T-bills and rolling them every time they came due. And that was how you maximized your income, because rates were going up and up and up and up. So again, the mindset will change. It won't be immediate, and it's not something you have to really worry about probably this year. But as you move through the next cycle, you have to realize what we've had for the last 35, 40 years is very different than what we're going to have in the next 7 or 8.
And real estate, you gave a comment. I completely agree on farmland being an intriguing investment for wealthy American, or really any family, but especially into quote unquote America. But real estate's been a great investment, broadly speaking, long term, from depending on interest rates, leverage, is it income producing? But wow, COVID-19 changed some things, and the advent of technology building up, the Amazon of the world, retail, office, hotel, devastated. And multifamily housing, probably decent depending on the geography. But if the government enacts rules where if people can't pay their rent, then if there's nothing the landlord could do, then that could start to fall apart. So on the surface, I mean, I would say probably some allocation to real estate, but I would tread very, very carefully. What do you think?
I would tend to agree. I'm a contrarian by nature and by profession, and I would love to be able to look and say, let's take advantage of what's hit real estate very hard this year. But I look, and it's hard to be very bullish about the prospects going forward
Sure.
for the very same reasons you just mentioned. I mean, I can't imagine retail America coming back in any big way. It's going to come back somewhat when we open up, but we have changed the way we shop now. Same thing, we have changed the need to go into cities in large numbers to work. People have tasted this and they like the idea of not having onerous commutes. So I think I wouldn't want to be a real estate investor right now. There's probably going to be some pockets of opportunity, but I think it's going to be a lot tougher going forward. And as you say, you know, uh, I'm not sure how this works out in terms of what there's a whole bunch of um, policymakers that don't seem to understand that, it's not just the person that has to pay a mortgage or has to pay rent. There's money that has to be paid on those loans. The real estate landlord or bank has to be paid too, or this thing all falls apart. So I'm not sure where we're going with all this. Maybe they think the government can just take care of everybody, but we're right back to that MMT dilemma. So I think it's going to be hard for a lot of real estate. I have said often, people think of real estate as an inflation hedge. And so with my inflation forecast, people say, yeah, well, real estate, right? That's a good place. And I go, keep in mind, in the last many, many years, we've bought real estate on the basis, particularly residential real estate, on the basis of the mortgage payment that is driven by the low interest rate. If you're going to have mortgage rates go from 2 or 3% up to 12 or 14%, there's no way you can make the case that real estate's going to be a good inflation hedge.
I agree. I mean, I think there could be pockets, possibly selectively multifamily, but that's a little debatable.
Yep.
Warehousing, data center, storage.
Sure.
I think that could be a play, but for significant families, that's not the office space, the gigantic multifamily housing, and some of the hotels and areas that they're used to. It's a little bit more nimble and nichey and more fragmented, but that's what may make it intriguing moving forward. I do want to go back to equities. Short term, again, the US dollar reigns. I agree with you. But in the equity market, as that may falter relative to the US dollar reigning, that may mean a comeback in emerging markets.
Yeah, I think the emerging markets in the next cycle will certainly play. I'm not sure that and they'll play into this. I believe this is we're moving into what is I call a peak of a 38-year secular bull market that started back in 1982. So I think emerging markets will certainly participate in this final move, whether it be the next few months or the next 4 or 5 months. And then, like I said, in the next cycle, I think emerging markets make some sense, particularly, select ones. But, a lot is getting through that bust. And I think emerging markets are going to struggle in that period.
And back a little bit to gold and commodities, and and people don't take this the wrong way, and I'm one of them as well. Just the average investor, we could have access, and we could question it a little bit, but through ETFs, possibly some public companies, public mining, etc. For a very, very, very wealthy family, that may be part of the picture, but they may also want and desire direct ownership. But now we're talking about large dollar amounts in actual oil, which would be rare, but you could, I mean, I still see it, gold and silver. How would you recommend for larger scale? Do they own the bullion and have it stored at a Swiss bank or off the grid of a banking system? Do you have any specific opinion?
Not really. I tend to believe that this cycle paper will be okay. There's all kinds of people worried about whether, paper is going to get, if you're invested in paper gold or what have you, you're not going to get paid back. I think this cycle, everything will be made whole. We have the government, as I say, in deflation, the government has limitless, or the central banks have limitless ability to print money. It's once you get into inflation where their hands get tied. So I think they're going to be faced with, free falling situation. They're going to respond with all kinds of aid and money. So I'm not so worried about paper here. And frankly, I'm not a person that's an expert in physical gold by any means. But I would just say, there are a lot of drawbacks to it. People say, "Oh, I'm going to have physical gold so I can take it with me," and try hauling that across borders. But so I'm not so worried about paper this time. I think as you get through the recovery cycle, what comes on the other side of that, when you have massive debt buildup, and it's going to be every bit as high as this or higher, and you have hyperinflation, that's a combination where you can run into something that is not fixable, and where you can end up in a very long, drawn out depression. So I think the 2030s and beyond is a whole different story in terms of what may come. And in that kind of an environment, paper, all kinds of paper is probably not going to, make it. So, but I think in this down cycle, even though it's going to be a pretty dramatic bust, I think the paper is probably going to be okay. Now, we just saw last March, ETFs, et cetera, can get pretty volatile, and rules can change while you're there. So I'm not saying there aren't some, cautionary signs out there that, you have to be very careful here. But ultimately, I think people can invest in the mining sector and things like that through the stock market and do okay.
I know it may not be your wheelhouse. I feel like I still have to ask it. Do you think that Bitcoin could take some of the shine, pardon any pun, off gold?
Yeah, well, it certainly is or has done that this year. I don't follow Bitcoin, and I don't follow it partially because I don't really feel it's a macro story. It's, to me, more, I don't want to say it's a cult thing, but it's captured the fascination of a lot of hedge funds and stuff. And I want to see how it responds in something like the global bust before I start endorsing it as something that has longer staying power. I'm far enough away from it that I can claim I'm totally ignorant of it, but it's but it really is something that I just don't feel is truly I'm a conviction investor and a conviction strategist because I've spent almost 50 years of my time doing this. Bitcoin, I can't have any conviction. To me, it's somewhat contrives supply and demand, and that's just not how I think healthy markets work. So sure, you can get a thrill out of it, and if you're a momentum investor, it certainly is giving you plenty of a momentum to play, but I just don't know if it has long-term fundamental staying power.
Do you have any specific opinion about, and this goes back a little bit to MMT, inflation, and a little bit of the scary thing of government control opinion? And it relates a little bit to Bitcoin, but that's decentralized, but a centralized central bank digital currency, wickedly efficient, almost beautiful, but now the government knows everything. They'll take your taxes from it. They'll charge different people different interest rates. Suppose they say that if you're not investing in the public markets, you're going to have to pay a higher rate on this or that. I mean, these are things that may happen. I know you and I come from an era like, I don't believe this, but this kind of is coming.
Yeah, frankly, our last election tells you, I have said for a long time, not to get too political here, but really, it wasn't a Democrat Republican type of story this time or in the last 4 years. It's really Trump. Trump was the anti-globalist, and what we see is, and certainly with the Biden administration, it's much more of a globalist mentality out there that wants to knock down sovereign borders and wants to have a global currency, et cetera. It does not favor the dollar long term. It does not favor kind of what you and I grew up in, and I can't rule out, some sort of a digital currency worldwide that, it's more Big Brother is watching you, knows everything about what you're doing, and I think that's across the board in so many things, and it's happened so fast. I mean, part of it's because of technology, and part of it's, we've been kind of moving toward in this direction politically for decades, and we've reached that point where it really is looking like we're seeing major changes. So I don't know if we can reverse that now, but I think it's very dangerous because I think it is much more government is in charge and you don't have individual freedoms. And I'm not saying we're there yet, but we're moving in that direction, I think, much more rapidly than I would have ever thought would happen.
Yeah, same here. Perhaps my final question, and I'll leave it very broad, answer as you want. You probably knew the question was coming, and basically it's the US and China. And I know your perspective is not going to be to answer it from a political perspective, probably more so from the impact macro and perhaps on investing.
Yeah, it's interesting, and I said this before we got into so much friction with China this year, but or in the last year, but it's I go back to 1987, and I was at Fidelity at the time, but we had the 87 crash, and I remember sitting around, it was probably mid 88 after the 87 crash, and I was the only one that was bullish the US market at that time. Everybody else was bullish the Japanese market. The Japanese market had another 6 or 9 months to go, I think, until it topped out and then was down for decades. It begs the question here of whether, this is our, whether we're Japan, yeah, and China's us. And I think that's possible, but I also think the possibility is there because Japan is everybody wants to believe it's some kind of an economic miracle, but when you look at their debt buildup, their growth has almost entirely been the fact that they took on a lot more debt per capita than we ever did, or a lot more debt per GDP than we ever did. And so if we get this global bust, I think a lot's going to be determined by how they are able to come out the other side of that, because we're leveraged a lot. They're leveraged a lot more.
That is true. And probably that's not spoken about enough. It could be mutually challenging. Well, David, this has been great. Maybe in a closing comment that we'll get to how people can learn more about your services. What are some key takeaways for wealthy families and investors? One that really stood out to me that you said, and I concurred, was just now, and especially now looking forward, now, next year, next 2 year, next 3 years, is not the time to just sit back and I'm a long-term investor. It will play out good in the next 20 years. And you know what? That person long term might end up being a little bit right over 20, 30, 40 years. But my argument to them would be, imagine how far you'll be ahead if you're more tactical over the next 1, 3, 5, 10, 20 years. You may be 3, 4, 5, 10 times ahead of simply doing nothing. What are some key takeaways for people?
Yeah, I'll answer it this way. Back, back in the 80s, we kind of took on the financial industry took on the mantra of it's time in the market, not timing the market that's important, right? So that fit for a number of reasons. One, you had the baby boomers moving into their financial accumulation stage, starting to really worry about retirement funding, et cetera, and investing. And so the financial industries really took off. You had a lot of new people coming in as financial advisors. So it was a much easier thing for the financial companies to manage in terms of saying, you're going to do fully invested type, taking care of your customers. You're not going to be churning accounts like happened years ago. So that was part of it. And part of it was, as I said before, with interest rates trending down through many decades, it was the right advice, time in the market, because as we've seen, the indexes and stocks just kept moving up and up from the left corner up to the right hand top. And so we are moving into a period where I think there's a lot of give back. My forecast for, following this melt up is a potential 80% decline in the S&P.
Wow.
Could be 70, could be 80, but I think it's going to be bigger than certainly 2008-9. You take that step down and try to get that back in the environment I described, it's not going to be easy. So preservation of capital, I think, is very important to people now. Don't get greedy, and just beware. There's so many mantras out there that I think, or narratives that I think are false narratives, and be careful. Just because it's popular, just because there's a lot of people telling you something makes sense, doesn't necessarily mean it's going to work. So those are kind of broad generalizations, but I would, for example, Bitcoin, for example, indexing, for example, a broadly diversified portfolio. Those things aren't going to necessarily protect you in what I think is coming. Oops.
I mean, interesting. So I take a little bit away of, like you said, now's the time to be tactical, to perhaps be more concentrated. I'm putting words in your mouth, but definitely keep alert to commodities that could have a tremendous run. But we may go through a period of deflation very, very short term, and that could impact everything. But a little bit longer term out, inflation to hyperinflation, which simply is a time for you to be educated, to be tactical, assuming you're an investor. I mean, there's lots of questions that I had, but I'm going to leave on the table. I wanted to be a little bit more succinct, and certainly things that we could cover a little later in the year as things evolve. David Hunter, for those that would like to learn more about you, whether following you on Twitter, if you have a Twitter handle, subscribing to your services and learning more, how could they do that?
Sure. Yeah, I'm active on Twitter. My handle is at Dave H. Contrarian. And I do have a quarterly investment letter, macro letter that I put out. It's a subscription, so it costs, but you can find out about that by, probably the easiest way to get a hold of me is just direct message me on Twitter, and I'll usually respond right away to you and let you know, cost of the letter, et cetera, and you can go from there.
Excellent. And for everyone's knowledge, that's how I reached out to David. I've been familiar with him for a while. I simply DM'd him on Twitter, and I don't know, 12, 24 hours later, he got back to me. So I'm certainly glad he did. Everyone, in my conclusion, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association, a global membership organization dedicated to investors, successful families, and their single family offices. Check us out on our website. It's our company name, so it's easy, familyofficeassociation.com. Joining is very easy online, and it's an opportunity for our proprietary content, access to me, opportunity to be live attendees to all we do in terms of our hundreds of digital programs, and soon, to some degree, the return of physical events, as well as other services and consultative and peer-to-peer and mastermind groups that we put together online in a private forum as well as virtually in more of these Zoom type meetings for family office investors and others only. My direct email is angelo@familyofficeassociation.com. I'm very active on social media, mainly, especially lately, YouTube. We're Family Office. And by the way, on Twitter, I'm at Family Office. So that keeps that relatively simple. I registered those names many, many years ago. So I'm lucky to have good real estate on both those platforms. David, thank you so much.
Thank you, Angelo.